I'm going to show you guys a few common things when it comes to stocks. This is not always the case, but this is just the general knowledge that you should know. If you're trying to figure out like what stocks are, what trading is all about, that kind of thing. So let's start off with this top left graph right here. So as you can see, the one I drew, it goes up, down, up, down, up. So the areas where it says B, that is where you should buy. So when a stock is, steadily going up, you can see from this peak to this peak to this peak, it is going in an upward direction. It's bullish. So when the price dips down, when the stock price dips, those are good times to buy because that is when it's at its cheapest. And somebody in a YouTube video made a really smart example of this kind of thing. He was saying, if you really liked a shirt and you wanted to buy it and it was $30 and then tomorrow it goes on sale for 15, wouldn't you rather get it when it's on sale? And then, you have something that's $15 that's the value of $30. And so, well, in this case, you can make money off of it. I don't know necessarily if you bought a shirt, but you'd have that much extra, money. So let's say it's $30 up here. Let's say it drops down to 15. So you can buy in and then it can make its way back up. And then that is a good selling point. Or so you can either sell when when you see it reach its peak, maybe it's the highest it's ever been, or maybe you're watching its chart and you can see that it usually gets to about that point and it falls back down, which means people are selling their shares at these points. People are buying, buying. The price is going up, and then people sell, and the price goes down. So, because everybody is following this right here, when you buy down here, you're adding value, you're increasing the stock price, it goes up, and then people sell, it goes down. Now, if you buy and you sell, you can make some money. But if you buy and then you hold over the long term, if the stock is promising, then as you can see, if you sold here, maybe you make $32 on each share. Or you wait and you sell over here around this peak and you make $40 a share. But that would take more time. Or what you can do is you can buy down here, you can sell up here, and then you make extra money, and then when the price dips back down to where it was before, around that 15 mark, then you buy again with even more money, and then when the price goes back up again, you're making even more profit because you have more shares in there now. So that's just a general basis on some ways that you can trade. This is definitely better for long term, and you definitely have to have fundamental knowledge and maybe technical analysis, knowledge on it all. There's the fundamentals and there's the technical side. The fundamentals are better if you're looking at long term. Sometimes technical, can help with more short term or like swing trading, which I'm going to tell you what that is real quick. Day trading is when you buy and sell in the same day. Swing trading is when you buy and you sell the next day or the next few days or anywhere from the next day to a couple of weeks. That's swing trading. And then anything after that, that becomes long-term investing. But I guess swing trading does go out quite a bit. Like it can be a few months, but swing trading is a nice median between holding something forever and being really violent and selling right away and, making short profit or maybe a big profit, but quickly with maybe a larger capital, so you're making more off of your trades rather than having to wait. So those are the three types of trading, and this is more swing trading. This would happen more over days or weeks if we were talking about the price going up $15. That's a good bit. That's just an example though. So this is basically what I was getting at up there. You buy low and you sell high. That's the main basis of it all. when you're trading. There's other things like options trading where you can bet on it going down and you can actually buy up here, which is pretty interesting, but we're not going to get into that. We're just going to talk about normal trading right now. So down here, I have some overreaction plays. What this means is when good news comes out or bad news comes out, people will either overbuy or oversell a stock. And when they do that, it is bound to correct itself. So if something goes way, way down, if something goes way, way down, there could either be a big issue or, their earnings came out and it wasn't that great, but then their stock is good and it'll rebound. So it goes way down, like for instance, this one down here. It goes down, 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 and then you can see it pops back up. So that's a time when you can buy and sell right there, but you got to be careful about that. And other things I want to warn you about is when there's overreaction plays when it goes too high. You will lose a lot of money if you buy up here. Even if you buy halfway, it's very risky. So be careful with that. A lot of times when people buy and they're, buy on these days when it's like the graph is going up a lot, they're usually day trading and they're going to sell once it hits a peak. And once they see that it starts to go back down, they know that's when they need to sell. Or they'll look at the volume and, when they can see the volume's not going up as rapidly anymore, then you're getting close to a drop. So if you buy like down here and you see the price, starts shooting up, volume will start shooting up as well, most likely. And then it'll get to a point where a lot of people are in it and the stock is just too high, it can't support itself. People will start selling because they know this stock is not going to go that much higher. And so that's what happens, and then it violently goes down. And a lot of people will be like, oh, this stock is doing really well. They think it's going to continue to go up for days because it makes a really positive movement, but that's not true. This is just showing all these people very quickly are buying, and it doesn't necessarily mean the long term is going to be good and profitable and bullish. So keep that in mind. Do not buy up here. If you do anything up here, it's shorting. You can short, you can do a put, which means you're betting on it going down, and that's, like I said, another video. So over here, there are a lot of different chart diagrams that you can follow, or like patterns, and they tell you certain things. They're not always accurate, but a lot of times they are, and they're pretty cool. So one that I liked when I see it is the triangle. So this one is a diminishing triangle. It is going down. What that means is you can see over time this stock graph, you can just see it gets more and more condensed. So at first it's very volatile going up and down, but it starts to narrow in on its decision. So that's people are buying too much of it, people are selling too much of it, people are buying too much. And then eventually it gets to a point where it's not moving much. And depending on the angle of this triangle, tells you potentially whether it's going to go up or down. So in this example, the bottom is straight, and you can see the top is slanting downward. So people are slowly selling more than they are buying, which means in the end, this stock is going to go down. If this one was up here was straight and this one down here was upward, then it's showing that people are slowly buying more than they're selling, and then the opposite could happen. So that's just an example of some of the patterns you can see. There's a lot of them that you can look up on YouTube, and they're pretty cool. I like when you can see things like that in your charts. So a lot of stocks, like let's say NIO, for instance. NIO is an EV stock, and its volume is always going way up, and the price usually follows. But let's say towards the end of a day, it's going up a lot and a lot. People sell out at the end of the day, potentially. Then the volume goes from 60 million down to 20 million. So 40 million people sold, which means that the stock will drop. So keep that in mind. Ride the momentum of high volume stocks, but be careful for when they sell out. But also, with a bunch of stocks, the beginning of the day is when they shoot up the most. So if there's certain stocks that you've seen their history and they usually shoot up in the mornings, and maybe some good news comes out, or maybe it's just a normal day, but you're watching everything closely, you kind of have to take little bits and pieces of everything and make one conclusion with it. So over time, you'll definitely learn that if you stick with this stuff. But back to this. So right here, we have, let's just say, volumes going up. Volumes rising, and then you get to this point, and let's say it's the highest the stock has ever been. And let's say there's no amazing news out that's going to keep it going. And maybe you see the volume when you get up here, as you can see, it starts to flatten out. Nobody else is buying in, nobody's selling, they're just kind of waiting to see what happens. And then people start to sell. And then it drops. But if it's a good stock, you can buy towards the bottom of that sellout, and you can ride it back up with the momentum, because the momentum will come with volume coming back, and the volume will come back if it's a good stock. But yeah, when you get up to that high point, that's usually when people sell. So be careful. Don't buy up there. If you can sell up there, for sure, but just keep that in mind. So I hope some of this made sense and it was informative and you could understand some more things. There's a lot that goes into all this, and I just hope this helped get a little bit of the point across of what happens with stock graphs. And yeah, so hope you learned something. Good luck trading if you do, but be careful, and I'll see you guys next time.